Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Coming up on the show today, Kash Pashutan, CEO of First Avenue Investment Council, is our guest co-host. Then in 30 minutes, we're talking to Daniel Sachs, founder of Canadian Strategic Missions Corporation. And of course, we want to hear from you on First Call. You can reach out to us with your questions on North American equities, and Kash will answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. Phone lines open in about 30 minutes. You can also email firstcall@bellmedia.ca. Now, some of the stories we're working on in the BNN Bloomberg. Bank of America's fourth quarter net interest income topped estimates. Revenue from equity trading rose 23%. The second largest U.S. bank says it expects further economic growth in 2026 as consumers and businesses continue to be resilient. The bank has benefited from recent market volatility, leading to a surge in client activity as investors reposition their holdings. Meanwhile, Wells Fargo missed profit estimates in its latest quarter as severance costs drove up expenses and net interest income fell short. Revenue also slightly missed estimates. The U.S. bank says it operated with some constraints during the year, referring to an asset cap imposed by the Federal Reserve that was lifted only in June. The bank says it plans to continue shrinking headcount and is looking to use AI to improve efficiency. Chorus Entertainment saw revenue drop 18% in the first quarter as a prolonged advertising slump continued to weigh on the company during its restructuring. The media company posted a net loss of more than $11 million, with TV revenue taking the biggest hit. The company says the completion of its proposed recapitalization transaction will deliver substantial balance sheet improvements. And now our top-line story. Prime Minister Mark Carney has landed in China, marking the first trip to Beijing by a Canadian Prime Minister since 2017. Carney is looking to expand Canada's pool of international trading partners with this visit. He's set to meet with President Xi Jinping on Friday, when the two are expected to sign some joint agreements. For more on this pivotal trip, let's bring in our guest co-host, Kash Pashutan, CEO of First Avenue Investment Council. Kash, thanks very much for joining us.
Thank you.
Your thoughts on this meeting? I just saw a stat that came out. Chinese imports from Canada dropped 10% last year, down to $41.7 billion. A huge drop-off for us. Your thoughts on this trip, and what do you think we'll see from it?
Well, it's certainly an interesting trip, as you mentioned, given that it's upwards of 10 years since it's happened in the past. I think more than the trip is the timing of it is really interesting. And I think for Canada, in some ways, I think we need to be careful here because obviously from a geopolitical lens, I would hate for us Canadians to be viewed as sort of forming an alliance with China at a time where relations are very sensitive from U.S. to China. And as we know, President Trump and the current administration picks sides and picks teams, and if you're not on those teams and on their side, then often it's a challenging ride. And so the last thing we will want as Canadians is to have our neighbor in the U.S. View us as being on China's side and make Canadian-American trade relations even more difficult.
I mean, we saw Trump yesterday say we don't need cars made in Canada, and he called Kuzma irrelevant. It really is a delicate balancing act that the Prime Minister's doing right now.
Yeah, and listen, I'm certainly no politician, but I think that the U.S. is a mega force as we know it, and given that they're our neighbor, if you're asking my view, I think we should be spending time and energy trying to repair that relationship and not snubbing it, because at the end of the day, we need the U.S. and certainly that everything has been put on hold. We could talk about the reasons why discussions fell apart, but it's almost irrelevant at this point. I think we need to really be focusing on getting the Canadian-U.S. relationship back on track. And the reality of it is, whether we like it or not, Canada needs the U.S. a lot more than the U.S. needs Canada. We're seeing evidence of that almost on a weekly basis. And so if we're looking at what's best for Canada as we move forward here. Trying to elbows up or show the U.S. that we don't need them is, in my view, a very emotionally driven approach. And we should get back to focusing on getting that American-Canadian relationship back on track, which, as we stand today, feels like a very, very far objective.
But how do you work on repairing a relationship with Donald Trump? Sometimes it doesn't seem possible.
Yeah, I mean, I got to tell you, I know that is the narrative out there, but at the end of the day, no one likes to negotiate a deal more than President Trump. And so, it comes down to the negotiation. He's cutting deals on an hourly basis, on a daily basis. And so I think we can say that we can't negotiate with them, but maybe some people can't, but many people can. And at the end of the day, if maybe Canada won't have as good of a deal as it did before, but a deal that is not as good as before is better than no deal. And time is going by. The U.S. is not waiting for Canada to decide to negotiate and do a deal. I mean, we're seeing it. So I think Canada is being left behind in the dust while the U.S. continues to move forward. And I don't think it's serving Canadians well. I think we need to get back to negotiating a deal. It felt like Prime Minister Carney and President Trump were close to a deal, and then things fell apart. Someone's got to take the first step. And again, I can't comment on things that I don't have sort of insider information on, but to be going to China right now, where we need to be focusing on getting the Canadian-U.S. trade relations back on track, it just, as an outsider looking in, it does not feel like that is a priority.
And with China, what concerns do you have if we do strike any deals with them?
Well, look, I think if, again, I'm speculating here, but in my view, it looks like if you're either a friend of the United States or you're the enemy. And I think Canada has to be very careful here to not be viewed by the U.S. as parting or forming an alliance with any party that the U.S. views as being an enemy. And so the last thing we would want to do is be put into that bucket. I think Canada has gone from being an ally to the United States to neutral, and we want to go back to the ally bucket. We certainly don't want to go to the other bucket, which is a competitor or an enemy. I mean, you could put whatever label on it, but certainly not an ally. So we're probably in the quasi-neutral bucket or territory right now. I think as a Canadian, we all want to see Canada-U.S. relations get back on track and get back to the ally bucket. Okay. I don't know, talking to China right now and forming a buddy-buddy friendip system, and I'm not saying that's necessarily happening, will do that for us.
Okay, we got to wrap it up there, Kesh, but thanks for joining us today and for sticking around. We're going to take a look at the markets before the bell as we head to break. See how things are shaping up on the markets. We'll start with the U.S. futures and bank earnings season ramping up. Investors playing a little cautious. You can see everything is off right now. Dow down by 0.3, NASDAQ off by about a half point, and the S&P 500 down by 0.4 right now. Heading to Asia. Look at the Nikkei riding a weak yen and the possibility of that snap election. The Nikkei hit record territory. It was up nearly 1.5%. Hang Seng also up by 0.56, and the CSI 300 off by 0.4. Heading over to Europe. Energy and utilities are outperforming after European power auctions. You can see the FTSE still solidly above 10,000, up 0.36%. CAC 40, bit of a wash, and the German DAX off by 0.35. The TSX, just barely ending up in the red, hardly worth mentioning. Bit of a give back on losses in financials and industrials left the TSX in the red, but still the second highest close on record. And some of the winners and losers on the plus side. Enerflex up nearly 7%. Cenovus up nearly 6%. Going the other way, Aero Copper down by 3.76%, and G mining off by 7%. And taking a look at metals, holy cow, they are going crazy again. You can see gold, it is up 0.85%, 4,638 right now, all in record territory. Silver futures look touching $92 an ounce, up 6.5%. And copper surging as well. It's up 0.36%, over $6 right now. And looking at oil, it is on an upward move right now. It's up yesterday. WCS, Western Canadian Select, up 3.31%. And taking a look at WTI, it's also up right now, nearly at $62 after sitting around 55, five-year low about a month ago. It's up 1.25% today. And as you saw with the metals, they've extended that dramatic run. Gold, silver, copper, tin even, they're all hitting record highs. For his perspective on this sector, let's bring back our guest co-host, Kash Parshutan, CEO of First Avenue Investment Counsel. Kash, thanks as always for jumping in on this one. We'll start with gold, but silver is in there right now. What's fueling gold right now?
Well, I mean, I think just putting the performance into perspective, in 25 years of managing money, I've never seen this type of move in the price of gold. To put it in perspective, just last year, gold bullion, the commodity itself, was up 65% in 1 year. That's not a record in the last decade or two. That's actually the highest increase since 1979. So what we are witnessing is something in many ways unprecedented for decades now. And the big question is, does the move continue? And as if you're an investor, how do you participate in it? Is it in the Canadian market or the US market? Both markets have benefited from this. But I think a really important stat for viewers and for investors is that if you are looking for exposure to gold, especially through a broad market, the Canadian market is really where to get that. About 14% of the TSX is comprised of gold companies, where in the S&P 500, it's less than 0.25%. So that's a really important fact. We like gold here. We think it's going to continue to move. It's about 15% weighting in both of our two equity strategies. So big move. And we continue to believe that the reasons behind the appreciation of the price of gold continue to be there. And I would narrow that list down to two main factors: geopolitical uncertainties and the fact that global central banks, broadly speaking, are continuing to reduce interest rates. These two factors are both very positive for the price of gold.
Any concerns about speculation starting to play a role in this?
Yeah, I mean, I'm concerned about everything every day, all day long. But look, I think I think everything is relative to the weighting in your portfolio, the weighting in your fund. I don't think it's too late to be entering gold, even though it's had the run that it's had. I wouldn't be necessarily loading up at these levels. But if you're an investor, to have 5-10% of your portfolio in gold or gold bullion is appropriate, even with the appreciation that we've seen. To go load up 25-30%, I wouldn't advise that. But I think that it's important to remind ourselves that gold plays a different role in the portfolio than owning common equities. And so from a diversification perspective, I don't think it's too late to have some exposure here. Obviously, anything that's appreciated as much as gold has in a short period of time, you could argue a lot of the juice has been squeezed. But from a portfolio diversification perspective, we like gold. We continue to hold gold, and we like it even as an entry point in a modest manner for new positions.
Okay, and you talk about gold's and surge, but also silver right now. It's up. I think what did I just say? Was it 92? I can't even keep track anymore how fast it's going up. What's driving that, and what are your thoughts on it? Are you anywhere near it?
Yeah. So silver. We like gold because it's really the flagship metal commodity, and so we think it's the more conservative way to build a hedge and to have exposure to precious metals in the portfolio. But naturally, when you have sort of the big brother or the big sister have the run that gold has had, Then investors cycle to the next best thing, speculating on, well, if gold went up this much, then silver needs to go up this much. It's for us, silver becomes a little bit more of a speculative play. We're bigger believers in gold, and I think again, I wouldn't be turned off or pushed away from not having some exposure to gold, despite how much it's appreciated. And I think the question investors have to ask themselves is, do I want to get exposure to gold through the actual commodity, gold bullion, or do I want to buy gold companies? And they have different pros and cons, and in terms of buying the bullion versus the actual gold companies.
And what are some of the pros and cons for weighing on that?
Well, the big, I would say the big difference is when you're investing in gold companies, you have actual management risk, but also management opportunity. It's an active, live, living, breathing organism of a business. And so a great management team can have the share price of a gold stock actually outperform how much gold bullion or the underlying commodity appreciates by. But you also, as much as humans can do great things, they can also underperform and make lousy decisions. And so there is environments where you have an underlying commodity like gold appreciating, but the actual business or gold stocks are not. And that's because of often what's going on specific to that company or a result of decisions that management has made. So in a perfect world, you find great management teams combined with a great commodity in terms of where it's at in the cycle. But I would say that's a higher upside and a higher low downside scenario. So for, if I could use the word average investor, if they're looking at having some exposure to gold, the more conservative way is to do it through the actual gold bullion.
All right, we'll leave it there for now, but up next we'll be talking with Cash. He's the CEO of First Avenue Investment Counsel, to see why Lennox International is on his radar. To see what's on the radar for Cash Pashutan, CEO of First Avenue Investment Counsel. And Cash, two stocks today. First up, Lennox International, going old school.
Old school, old is gold, and we're going to talk about a gold stock later. But we like boring here at First Avenue, and Lennox is about as boring as it gets. They're a manufacturer and distributor of HVAC, so think heating, cooling, ventilation. We need it in every single home, every single apartment building. And what's interesting about these folks, so I would say this is a conservative way to get into the space. Why? Because 75% of their revenue comes from replacing units and 25% from new construction. That matters because if a large part of your revenue comes from new construction and the new construction sector slows down, you're very much at the mercy of where we are in the economic cycle of new builds. But for these folks, 75% of their revenue comes from replacing older units. And there's some growth catalysts that are really coming to fruition here. One is climate change. You're seeing in southern parts of, for example, the United States, it gets hotter and it stays hotter for a longer period of time. So this requires larger, stronger machines to be able to operate. We're also seeing new environmental regulations. So not to get overly technical, but there's a rule in the United States phasing out the use of R410-A refrigerants for more green and friendly. And this is requiring these machines to be phased out and changed and new machines to go in. So that's another growth catalyst. And then the other thing that we're seeing is, look, these HVAC mechanical systems are big ticket purchases for the average household. And the United States, as we know, is in an interest rate cutting environment right now. And so that frees up room for families to be able to upgrade and make purchases like this. So large player, their 75% of the revenue comes from replacing, not new construction. So we like that. And then the three growth catalysts, from climate change to new environmental regulation, as well as a reducing interest rate environment, we believe position Lennox well for 2026.
And do we know what drove it down there over the last year or so?
Yeah, I mean, look, I think that we've had a slowing economy in the U.S. As you know, the U.S. President Trump and the administration have really been pushing for lower interest rates because the consumer has been strapped, has been challenged with higher borrowing costs, less ability to spend, and that has had an impact on Lennox. But again, we think that we're entering in sort of the opposite environment now with so much pressure for interest rates to be cut, and we do expect rate cuts to start happening in the U.S. this year, and we think that that will be a reversal of the consumer's ability to spend on items like this.
And I mean, it's a company with a track record, right? They've gone through this before.
Oh yeah, yeah, absolutely. And look, at the end of the day, there is, this is almost a necessity, and so they're not in any sort of new technology. It's not an if. It's not. There's no adoption here. You don't have to educate or convince the market on why they need HVAC mechanical or the latest and greatest in their homes. So from that perspective, very much meat and potatoes. And those growth catalysts are going to help it come to life in 2026.
All right, and let's sneak in Alamos Gold. What are you liking about that?
So we were talking about gold in the last segment, and I was saying that being in the commodity itself is a more conservative, defensive way to get exposure. If you wanted to go to the actual producers, I would say within the world of producers, Alamos is one of the more conservative ways to play it. So they're a Canadian gold miner. They've really built sort of I'll say a brand for operating in safe jurisdictions, the Island Gold District, Young-Davidson, Mulatos, and I always butcher the name Mulatos District. So they again, one of the things you got to watch out for these producers is where are they operating. So Alamos has, as I said, built that reputation of being in the more safe jurisdictions. That's why I say if you're looking at being in gold outside of the commodity and the producers, this is a name to consider. And look, they're doing a lot of things really well, and probably one of the most important things they're doing well is their ability to generate free cash flow. So record free cash flow in Q3 of 2025 to the tune of about $130 million. That's 54% increase quarter over quarter. So great free cash flow. And remember, we like the underlying commodity of gold. So you put those two things together, and this is a name that's definitely on our radar.
All right, we have to wrap it up there, Cash, but we'll be talking to you a little later on in the show. But next up, we're talking to Daniel Sachs, founder of Canadian Strategic Missions Corporation. And of course, our phone lines will open soon for first call. You can reach us at 1-855-326-6266 and email us firstcall@bellmedia.ca. Luxury retailer Saks Global has filed for bankruptcy. The American company is preparing to reposition itself after obtaining about $1.75 billion US in financing commitments. Saks' top executive stepped down earlier this month as the firm struggled with debt from its acquisition of Neiman Marcus in 2024. The retailer is also facing increasing competition as customers resist price hikes. Bank of America's fourth quarter net interest income topped estimates. Revenue from equity trading rose 23%. The second largest U.S. bank says it expects further economic growth in 2026 as consumers and businesses continue to be resilient. The bank has benefited from recent market volatility, leading to a surge in client activity as investors reposition their holdings. Meanwhile, Wells Fargo missed profit estimates in its latest quarter as severance costs drove up expenses and net interest income fell short. Revenue also slightly missed estimates. The U.S. bank says it operated with some constraints during the year, referring to an asset cap imposed by the Federal Reserve that was only lifted in June. The bank says it plans to continue shrinking headcount and plans to use AI to improve efficiency. Quick peek at the markets. Shaping up to be another off day for them right now. You can see the Dow down by about 0.3%, a little under that. The Nasdaq off by about a half point, and the S&P 500 off by about 0.4% right now. Well, Canadian Space Mining Corporation made one small step with its rebrand to Canadian Strategic Missions Corporation. It happened last month, but it's a giant leap developing mission-critical technologies. Here to talk about the future of Canadian space and the company's contribution to that, and on the ground as well as the founder of Canadian Strategic Missions Corporation, Daniel Sachs. Daniel, thank you very much for joining us today.
Yeah, thank you for having me. It's an
All
honor
right,
to be here.
let's talk a little bit about the name change. Why change that from space?
Well, we're
still going there, right?
Yeah, we started with humble beginnings with plans to process resources on the moon to support humanity's exploration efforts there. But as we did that, we started to expand our focus, and that led us to a number of dual-use technologies in healthcare, energy, resources. And the core focus of the company really shifted from being a space mining company towards one that was developing dual-use critical strategic technologies.
And so what are some of the technologies now that you've been developing?
Yeah, I think our core focus is really harmonized around our nuclear reactor, which we call Lunar. And that is a micro-reactor transportable within a shipping container for powering Canada's defense needs in the Arctic or for putting a reactor on the moon.
Now, people have heard about modular. There's been a lot of talk about modular reactors for AI data centers. Is that a modular reactor or is it different?
I mean, the term modular reactor is used to encompass both reactors that are modular and not modular. Yeah. We are trying to build very small reactors, so-called micro reactors or nanoscale micro reactors that are about this large that could be transported within a shipping container. The Arctic, in particular, Canada's need to build defense infrastructure in the Arctic all right now relies on diesel energy. That is a logistical nightmare for the military. It is killing the planet and people's health in the Arctic. And so it is a resource and mass limited market. You are limited in the Arctic only by what you can bring there through the logistics networks. A lot of the defense spending is targeting areas that have no road access, have no boat access. And so the only way to get these reactors or power sources in is off of a C-17. And so we are designing a reactor to fit within the payload of a C-17.
Now, are there not concerns? I mean, there's concerns obviously about the damage to the environment with the diesel, but are nuclear as concerning? I mean, if there's a plane crash, or how long do they last when you get them up there, and then what do you do with them when you're done?
Yeah, so we're working through all those issues. They're obviously complex issues as it relates to nuclear, but nuclear is a fundamentally a safe technology. Less people have died in nuclear accidents than have died in construction of wind turbines or typical construction that goes on a daily basis. It's a very safe industry, although there is a lot of scaremongering that occurs. We're planning on a 5 to 10 year life for the reactors, so they would be shipped into place, power for 5 or 10 years, powered down and cooled down over a period, and then returned to factory for refueling and refurbishment, and then sent back out into the field.
And there's some pretty good, but the challenge is working with the cold up there. They do get heat in the summer, but the cold is a challenge. But that kind of sets you up for anything you're looking at in space too, because you said earlier that you wanted to get one of these onto the moon, essentially.
Yeah, we've been working for several years on that. We've received some financial support from the Canadian Space Agency in that area, and we've been leading Canada's effort to put a nuclear reactor on the moon. When you look at it, Canada has one of the leading nuclear industries on the planet. We are what's called a Tier 1 nation in nuclear. We are also a leading nation in space capabilities, space robotics, and when you marry those two things well, they give us a strategic capability that very few countries can compete in. And so we've been working to advance the reactor for the lunar surface and to deploy it in order to support the Artemis missions as well as the commercial activity that's going to begin in the next couple of years there.
And how has funding been for you? I mean, you're getting some from the government. Are you getting interest from the private sector as well?
Yeah, we've been able to raise a little bit of money from the private sector, and then we've been very good at winning contracts with the government as well as getting support. So we've won a total of about 17 various contracts with the government over the last 3 years. I think we're probably one of the fastest growing companies in this area within space and defense. And then, a number of contracts with the CSA. We most recently won a contract with D&D for the nuclear reactor. So we have the only defense contract in the Canadian nuclear sector. And so we're building a prototype reactor for D&D, an unfueled version of it, to demonstrate to them this summer. And then we, in December, won a contract with NATO as part of the NATO Diana Accelerator. So we'll be building to NATO standards.
And would that include the U.S., or is the U.S. a separate market with the defense down there? Have you had any luck down there?
I think the U.S. is a separate market. We continue to be engaged in conversations there, but obviously it's a precarious situation right now for Canada and Canadian companies to manage. We see a great opportunity right now with what we're doing in the Canadian Arctic. We are a very patriotic company. We are very focused on delivering capabilities for Canada that are unmatched globally, and doing so as quickly as possible in order to secure Canada's northern security.
And you went from real estate to this. What was that like, making that transition? And what was the reaction from people when you were trying to raise funds and trying to get people interested in this?
Yeah, I think it was one of dismay and impossibility. Beginning of the pandemic, like many, I had an existential crisis. I'd worked on about $4.5 billion of real estate deals in my career, anywhere from working for the former president of Brookfield, Bill Pringle, to working for Hudson's Bay for Richard Baker, and a number of jobs in between. Beginning of the pandemic, I had my version of the existential crisis was I realized I wasn't sure what impact that those deals had on the world. Investors had made money, and that was great, but was I squandering the time of my life? And so that led me to starting a space company. I guess as a business person, I wasn't that technically grounded.
And the concept of sales is the same no matter where you go, right?
Entirely. And so set out to build a space company in the space mining area, and then, of course, have navigated those opportunities throughout the way. Look, I think there were a lot of investors and people within, quite frankly, the space sector who said it's impossible, and we've built one of the fastest growing space companies in Canada. So I think I'm pretty happy with the way our team's been able to succeed in these areas, and now we're doing that within defense as well, and nuclear.
All right, have to wrap it up there. One space joke. I know you like telling them still. You got one space joke?
Not a good one.
Not a good one. Okay, we'll leave it at that, Daniel. Thank you very much for joining us. Daniel Sachs is founder of the Canadian Strategic Missions Corporation. Still ahead, today's market drivers with Bloomberg Equities reporter Monique Malima. Put you on the spot, sorry. Now, look at some early market movers, and we're joined by Bloomberg Equities reporter Monique Malima. Monique, thanks as always for joining us. Let's talk some fuel. Chevron right now. What's going on with them?
Hi, yes, thanks for having me. So Chevron and SLB, their shares are both up this morning on reports that the companies are looking to expand further into Venezuela. Both of them are currently some of the only U.S. companies operating in the country, and reports are saying that they are working with the U.S. government to expand their production there even more, and also saying that they're the two companies that are expected to benefit the most in the near term on some of these changes that the U.S. is making in Venezuela and the U.S.'s focus on rebuilding the industry. So that's why we're seeing that movement today.
Okay, and Nutrien, where are they going? What's happening with them?
Yes, so Nutrien, their shares are rising this morning in pre-market trading, and this is after Morgan Stanley upgraded the stock to overweight. They see more opportunities for the company this year as demand for potash is expected to grow, and that should help Nutrien's earnings as well as one of the largest potash producers. They say that there's going to be some cost pressures on nitrogen and phosphate, which are some of the competitors to potash. So as a result, they see more demand for potash, and that's going to really benefit Nutrien.
And last one, let me see if I get this one right. Materion?
Yes, Materion. They are an engineered materials company, and their shares are rising after KeyBank upgraded the stock today. They see a lot of opportunities ahead. They make some of the engineered materials that are used for defense, and as more countries are focusing on increasing their defense budgets this year amid ongoing geopolitical tensions, they say that this company is really poised to benefit. They think they're going to start to see some of that in the fourth quarter results from last year that they'll be reporting soon, and they'll see continued strength as there's more demand for defense and for space and for some of their other materials as well.
Okay, we're going to have to leave it there, Monique, but thanks as always for joining us. Bloomberg Equities reporter Monique Malima. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including DoorDash. Let's take a look at some of the notable analyst calls and recommendations. First up, BNP Paribas started coverage on Uber and giving it an outperform rating, $108 the price target. Shares of the rideshare company are moving in pre-market trading off slightly. Analyst Nick Jones says while competition may pick up over time, we view Uber as a key player in the ecosystem, even in an AV future. BNP is also starting coverage on DoorDash with an outperform rating and a $280 US price target. The stock also moving this morning. The firm says DoorDash has, quote, a track record of strong execution characterized by driving adoption and increasing frequency in the U.S., expanding its international footprint through strategic M&A and delivering margin expansion. Iran is witnessing its biggest populist uprising since 1979 as widening unrest and a bloody government crackdown destabilize the country and the region with potential consequences for energy markets. Bloomberg takes a closer look.
What we're seeing in Iran right now is probably the biggest popular uprising against the Islamic Republic since the 1979 revolution. The protests this time are much more intense. These protests have huge significance both for the Islamic Republic as a regime, as a system of governance, but also in the region and in the wider world. Hundreds of people have been killed by security forces and riot police and plainclothes paramilitaries who are armed. We've seen reports of security forces using rubber bullets and live rounds. These protests erupted on the 28th of December, and the initial trigger was a sudden collapse in the country's currency, the rial. Spending power has been decimated because of inflation, because of sanctions, because of chronic mismanagement of the economy. A lot of it is also because of corruption. When traders in the Grand Bazaar in Tehran openly show dissent, it's important because historically they've been associated heavily with the success of the Islamic Revolution in 1979. There are a lot of people working in that part of the city whose livelihoods depend on imports. And if the currency is declining so dramatically in value, the cost to them of running their businesses just evaporates. Much of it, again, is tied to the government's ability to withstand the impact of sanctions. Sanctions means that Iran has a much harder time of selling its biggest single source of foreign exchange, which is oil.
Iran produces about 3 million barrels a day of oil. That makes it the fourth biggest oil producer in OPEC, behind Saudi Arabia, the United Arab Emirates, and Iraq. On top of that, it sits at the Strait of Hormuz, a vital choke point not just for global oil supply, but in fact for global trade. That's the second threat to global oil production in just over 2 weeks of this year.
The country's been dealing with double-digit inflation for a long time. Even bread is extremely expensive now in Iran. If you think about the fact that 10 years ago, a taxi ride from the main airport on the outskirts of Tehran to downtown Tehran was maybe the equivalent of $10. That's now the price of a single loaf of bread today. Since the revolution, there's been tension between younger parts of the population and the fact that the country's laws and constitution are based on a Shia Islamic interpretation of Sharia law. Reports show that young people are constantly pushing the boundaries of what they can do and what they can get away with. They want to engage with the world rather than to conform to what they see as deeply anachronistic and old-fashioned religious values that frankly alienate them.
The key moves from here are going to be how the diplomatic path forward goes. We've already heard from President Trump that he may consider striking Iran again. And if that happens, we're likely to see another bout of geopolitical risk premium added to oil prices.
The one thing to look out for next is any kind of news on talks between the US and Iran. We have to remember that the US and Iran haven't had formal diplomatic ties since 1979, so they always talk to each other through mediators, and Oman has been that mediator on many occasions. The last time that there were talks between Iran and the US through Trump's envoy, Steve Witkoff, Israel attacked the Islamic Republic and triggered the 12-day war, and that's something that has so far meant that Iran has been reluctant to engage with the Americans.
And when we come back, Kash Pashutan, CEO of First Avenue Investment Counsel, takes your questions on First Call. All right, time for First Call and first email. It's from Bob, and it says, "Good morning. Is gold still a buy?" Kash, I think you got your thoughts on that one, don't you?
Yeah, it's been the reoccurring theme today, Roger. So as I mentioned earlier, we certainly like gold. We've liked it for 4 or 5 years now. Gold, just to sort of put it in perspective, we manage at First Avenue 2 equity funds, North American, one more dividend focused, one more growth focused, and gold is about 15% of both of those funds. So we do like it. We like it for the more conservative investor. We like it for the more growth-oriented investor. Gold's had a huge run here, so I would just sort of asterisk that although we like it, a lot of the juice has been squeezed out of it. Gold bullion in 2025 was up 65%. So it's had a big run. We still like it here, though. And really, as an investor, the question you have to ask yourself is, do I want to own the commodity or do I want to own the gold companies? And as we mentioned earlier, some pros and cons. If you get it right with the companies, you can make more, usually during the same period if the commodity is rising, than you could owning the commodity itself. But you could also have it go the other way. Humans can make bad decisions and run the business inefficiently, and that can have an impact as well. But if you're looking for some broad-based exposure to gold as a 5 to 7% weighting, let's say, as a hedge, gold bullion is a great way to get that exposure.
Which way are you leaning right now, with the companies or gold itself?
Yeah, so I mean, listen, we got a great equities team that spends all day looking at stocks and analyzing stocks. So we feel like we can do the work to properly due diligence the actual gold producers, and as a result, we feel comfortable picking who we feel are some of the best in the space right now. We talked about Alamos Gold earlier. Lots of free cash flow, known for being and operating in safer jurisdictions. So there's a handful of gold names that we have in the portfolio, and we always prefer to actually make the investment decision with the management as part of the good and the bad of what could be.
All right, let's get another email in. This one's from Len. Your outlook over next year or two for a top-tier property REIT like Allied Property. It's trading at 1/3 NBV.
Yeah, I mean, look, I think one of the myths that's really been defunct, if I can use those terms, is that work from home is here to stay. I mean, people are working from home, but certainly not the same way that they were post-COVID. And we're seeing lots of institutions mandating folks to get back to the office. And so certainly for the office space and an Allied REIT, this is positive. I think it's positive. It has a ripple effect of positivity for the overall Canadian economy, but certainly for the office players, it's positive. Now, I will say that I wouldn't invest in an office REIT just because the overall theme has improved or the overall sector asset class has improved. You really got to get into the fundamentals and the financials, I should say, of these businesses. You're owning real estate, and so the amount of leverage on hand is very important. You can own great properties But if you have too much leverage on them, it could be problematic. So Allied REIT is on the higher side in terms of leverage. When you look at total assets versus total liabilities, when you look at total debt, or even when you look at total debt versus EBITDA as a ratio, they happen to be on the higher leverage side. It's not necessarily a negative thing, but certainly something to keep in mind. I wouldn't say that it's a screaming buy for us at First Avenue, but we do certainly like the space and are happy to see people going back to work.
Okay, and one last one we're going to try and sneak in. We've got about a little under a minute, let's say. It's from Peter. What are your thoughts on the Mag 7 for 2026, Meta in particular? And how do you see this year unfolding for the 4 quarters? A tough first half. Will it be Shakespearean?
Yeah, I mean, look, I think when you look at the Magnificent Seven, it really is the make or break for the index, and it's the make or break for most investment portfolios. And when the Magnificent Seven do well, this S&P 500 has a phenomenal year, and vice versa. I think it's important to note that the S&P 500 and the Magnificent Seven have had a few sort of blockbuster years back to back. So I would be cautious here. Not that we don't like the space long term. I think there's short term and long term. If you're buying these for the next 10, 20 years, start building a position now. But
I got to cut Cash. I got to cut you off there, but I'm sorry we're out of time. But thank you as always for joining us. Appreciate it. Sorry for cutting you off like that. That is it for us here on the street. Cash Pashutin, CEO of First Avenue Investment Council. Thanks for joining us today. Andy's up next with the Open. The market's open in 30 minutes. Have a great day.